Welcome to Dr. Fred Markets. This is not financial advice. Every day, billions of dollars move across markets that most people don't even know exist. Crypto, stocks, AI, the signals are there if you know where to look. And that's exactly what we do here. Let's dive in.
Wall Street is slowly turning your outrage into rent money. Signal 1. Taylor Swift's rehearsal dinner in New York just locked down a city block with security worthy of Gaddafi, while Swift's Eras Tour is on pace to generate over $10 billion of economic impact, and the finance bros already sliced her future catalog, live rights, and merch into investable royalty streams you never see. Signal 2. At the same time, art and music royalty funds are quietly raising billions. KKR dropped $1.1 billion on a single artist catalog. Hypnosis tried to package songs like mortgage bonds, and specialist platforms now trade fractional music and art rights like penny stocks. Signal 3. While you were doom-scrolling about protesters at the reflecting pool and daredevils climbing the Empire State Building, the real circus is in private markets where funds lend against this cultural collateral at double-digit yields that never touch public ETFs, even as the S&P ticks down a boring 0.13%. Here's the connection. Culture is collateral now, not brand value, not hype. Actual legal cash flows, ticket sales, streaming, merch, licensing are being chopped into slices and handed to institutions while retail fights over crumbs on Spotify. Taylor's security perimeter is a metaphor. The closer you get to the real money machine, the more gated it becomes. Everyone whines about rich people buying Picassos, but the modern game is sicker. You don't need a painting, you need the royalty stream. A painting is a standalone flex. A song catalog is a bond that pays you while you sleep. That's why pension funds, insurers, and private credit shops shove billions into these deals, while CNBC yells about Nvidia being down 1.39% today. Wrong arena. Mechanism time. 1. Define the asset. Music, art, even athlete image rights create predictable cash flows. Streams, sync deals, exhibitions, licensed merch. Lawyers wrap those flows into contracts. 2. Securitize it. A fund buys the catalog, then either sells fund shares to institutions or slices expected cash flows into notes with a target yield. 3. Leverage it. Private credit funds lend against those catalogs at, say, 10 to 14%, using the songs as collateral. If the artist defaults, the lender owns the soundtrack of your childhood. Retail gets trapped at the outer ring. You buy the label's stock or a random music ETF and think you're in. You're not. That's the equity wrapper. The real money is in the debt, senior claims on cash flows, packaged for the same people drinking $500 mezcal next to Taylor's bodyguards.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Now here's the one thing you didn't know. Spotify streams are being modeled like mortgages. Same math as pre-2008 housing, cohort curves, default assumptions, tail risk, except now the house is whether people keep looping Cruel Summer in 5 years. Quants run regression on replay behavior by age, country, and playlist position, then structure notes around projected streams. It's not vibes, it's bond math. So what do you do if you're not a pension fund CEO with a hotline to Carlyle? You focus on where this securitization pressure leaks into public markets. Step 1. Look at music royalty platforms and exchanges actually paying out cash, not governance tokens and vibes. Who takes a fee from every catalog trade instead of gambling on a single artist? House edge, not roulette wheel. Step 2. Watch listed companies whose entire business is owning rights, not selling t-shirts. Are they diversified across genres and eras, or YOLO'd into one aging rock star? You want boring, diversified cash gushers. If Taylor's catalog is the Ferrari, you buy the toll booth that charges every Ferrari owner to use the road. Step 3. Track private credit and alt funds leaning into this space. You won't access the fund directly, but you can watch the trend. When money floods into music and art as collateral, traditional yield instruments get crowded. That pushes institutions into riskier junk, while this uncorrelated stuff softens their blow. Translation: while everyone screams bubble in S&P at 744, the silent rotation is toward culture-backed yield. Today's lesson: the next bond market isn't built on houses, it's built on hooks and choruses. Your outrage at 5 Taylor tickets is the wrong reaction. The right reaction is, where is the royalty check going and who financed the tour? Follow that money. This is not financial advice, but here is the truth. If you only invest in what you see on stage, you donate your returns to the people backstage. 3-point summary. 1. Culture assets, music, art, likeness, are now bond collateral, modeled like mortgages. 2. Institutions own the cash flows. Retail gets crumbs via surface-level stocks. 3. Your edge is owning the toll booths and platforms that skim fees from every cultural cash stream. Subscribe if you want the map to the backstage, not another front row complaint. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.